Hello and welcome to another video from the Inspiration College. Now guys, if you are new to my channel, then I would love to welcome you, and if you are a regular visitor, also welcome you. And if you like the video, just give it a thumbs up. If you like the content, then guys, you can just leave your comments to let me know what you think, and most of all, to subscribe if you have not done so. So guys, what I'm going to do in this video is a bit different from what I would normally do, but when I really look at the content here on my channel, I think this is really fitting, because at times, when I've done a lot of videos on multi-level marketing and sales funnels group, which would, sometimes I would ask you to take credit cards out and loans out to finance their so-called business opportunities, and then you get yourself in debt. Now, this can affect your credit score, and that's what we're going to discuss. So what can you do to maintain a good credit score? And now the reason why I'm doing this video, guys, is because I have a good credit score which I'm going to show you, and because it's good, or I would say it's excellent, then I think I'm in a position to tell you what I've been doing to really maintain a good credit score, and how when you have a good credit score, you can really do a lot of things with it. So let us go into this video. Now guys, there are a few rock solid pieces of financial advice everyone should strive to follow. One of them could be save money for emergency fund. The next one could be pay down your debt, and don't spend more than what you can afford. But there are another bit of financial wisdom that many experts tout. Keep your credit scores as high as possible. So that is what you want to do, guys. You want to keep your credit score as high as possible. Now, credit scores are an important part of your financial health. You want good credit scores because they can unlock many savings and benefits, guys, including access to loans and credit cards with the most favorable term. So guys, I'm going to share 6 reasons why you want to have a good credit score. If we should look at like in America, and this can apply to other countries, like I'm here in the UK, so you could also apply this. Oftentimes, a lot of people rely on credit, the ability to buy things with borrowed money that's paid back over time, to finance major purchases such as buying a car or home, and to make life easier with conveniences like credit cards, which can help you manage your daily spending, guys. To determine whether you qualify for such loans, lenders may look at a number of factors, including your income, and you have what is called debt to income ratio, and even employment history. Now, let us look at what debt to income ratio is. So guys, if we look at what debt to income ratio is, or what is debt to income ratio, your debt to income ratio, which you normally hear people talk about DTI, that's debt to income ratio. It compares the total amount you owe every month to the total amount you earn. And lenders may consider your debt to income ratio a tandem with credit reports and credit scores when weighing credit applications. So when you apply for credit, especially if you want a mortgage or a loan, car loan, they would look at your debt to income ratio. And it says to calculate your debt to income ratio, you have to divide your total recurring monthly debt, and that includes things like your credit card payments, mortgage, and your car loan. So when you're talking about like bills like your telephone bill, mobile phone bill, gas bill, electricity bill, you don't normally include those in your monthly debt recurring income. You're talking about like your monthly debt, you're talking about like credit card payments, mortgages, car loans, insurance, and so on. So it says and you're going to divide your total recurring debt by your gross monthly income, and this gross monthly income is your income before tax. So if you know what your yearly income before tax is, then all you need to do is divide that by 12 to get your monthly gross income. And you're going to multiply by 100, so you'll get actually a percentage. So your debt to income ratio would be a percentage. And for example, if your total monthly debt is $3,000 and your gross monthly income is $6,000, then you would divide 3,000 by 6,000, and then you would get 0.5 multiplied by 100, so that would be 50%. But the thing about it, guys, is that you want to keep that number as low as possible. Your debt to income ratio as a percentage, you want to keep it as low as possible. So it says your income is not included in your credit report, so your DTI, or debt to income, never affect your credit report or credit score. However, many lenders calculate your debt to income when deciding to offer you credit. So if it's too high, and normally some people would say that below 40%, anything below 40% is a good debt to income ratio, because creditors would look at that before decide whether or not they want to offer you a loan, because they want to make sure that you are able to repay that loan. So that's basically what your debt to income ratio is, and you want to keep that number as low as possible. Some people would say 36% is good. You could even go lower than that. Some people would tell you that 40%, keep it below 40%. It depends on the credit company that's going to give you the credit. And of course, you have what is called front end debt to income ratio. You have back end debt to income. So like your front end debt to income examine only how much of your gross income goes towards housing costs, including mortgage payment, property taxes, homeowners insurance, and stuff like that. Then you have your back end debt to income ratio that compare gross income to all monthly debt payments, including housing, credit card, car loan, student loan, and any other type of debt. And so if you are applying for a mortgage, many lenders will prefer a front end debt to income of less than 28%, guys, to qualify for a loan. And they have what is called FHA loan, and you need to have front end ratio of less than 31%. So that's really what it is on debt to income. So now I'm showing you just this diagram to show you how you can calculate your debt to income ratio. So that's basically how you would calculate your debt to income ratio. You have your total debt, monthly debt, over your gross monthly income times 100, so you would get a percentage. So 6 reasons you want to have a good credit. So as I told you, a lot of people rely on credit, so you would want to have a good credit so that you can get good offers. But they also almost always rely on an automated valuation process that include considering your credit score and credit history to determine how likely you are to pay back your debt on time. So this is why checking your credit history is so important, because they want to see how you're managing your debt to know if they should offer you more credit. A credit score is a 3-digit number that's calculated by applying a mathematical algorithm to the information in one of your 3 credit reports. So you have one of the credit reporting body called Experian, like that one. I use that one a lot. Then you have TransUnion, and then you have Equifax. So all of these 3 credit institutions, they would have information on your credit score, and then you can get a credit report with all of these bodies having your credit information, and then they would give you a score. If your score is not good, then you would have to work on it to improve your credit score so that you have more opportunities when it comes on to borrowing. So the borrowing power, which are updated regularly with information from your credit account. Typically, the higher your credit score, the more likely you are to qualify for loans with the most favorable terms, guys, including lower interest rates, high dollar amount, and potential lower fees. So, sometimes when you want a loan, the interest rate is very high. And when you have a good credit score, then you are able to compare different financial institutions that's going to give you the loan, so you can choose the lowest. If your credit score is not good, then that option is limited for you. So you might end up paying higher interest. Sometimes I wonder, for someone who has a poor credit score, if they do get a loan, then the interest rate would be higher. You would want to think that you would want to give somebody with a poor credit score a lower interest, but of course, that would not make them work on their credit score. So they make the interest rate higher, so that either you refuse to take it out, or you'd have to work on your score so that you can get a better rate. And of course, when it's low, then you pay back less money. If it's high, you're going to be paying back higher amounts. And it says, so the other reason would be significant savings on your interest rate, as I just said, on big ticket loans. So when you take out a big loan, then your interest rate would be lower. When you take out a large loan to finance a big purchase like a home or a car, even a small difference in the interest rate can translate into thousands of dollars over the lifetime of the loan. So what that is saying is, when you take out a very big loan, even 1% lower than what you would get if you have a bad credit, or not really bad credit, because they would not lend you so much money with bad credit. But if your credit score is like good, then someone with excellent credit score would get a better interest rate than you. It says borrowers with the highest credit score are generally able to secure the lowest interest rates available at a given time for a mortgage or car loan. And that can mean big bucks, so you would be saving a lot, guys. For example, a 30-year fixed mortgage of $250,000 at 5.5% will cost a borrower a total of $511,010 over the lifetime of the loan. If that same borrower can get a 4.5% interest rate, just 1% lower, he or she will pay $456,017 over the lifetime of the loan. And guys, that's a difference of $54,993. So you see, when you have a good or a high credit score, then the interest rate can be lower, and this would be significant savings for you. And the other reason would be better terms and availability on loan products. So borrowers with strong credit scores will have access to the most loan and credit card products available, since lenders will want to lend to them. So I'm always getting a lot of emails of loans and credit cards available because I have an excellent credit score. But of course, guys, I refuse them, because for me, I have 3 credit cards. I even have a credit card with credit of £10,000, which I haven't. I have that credit card over a year now, and I haven't used a penny of it. So at some point, I'm thinking they're going to really take it back from me because I don't really use it. So what I normally do, I would normally just when I use money off my credit card, I would quickly go and repay that amount way before the due date. And guys, the other thing that you need to remember is that when say for example you have a credit card and you spend £50 or $50 from that card, and then you get a bill to say that you should make minimum payment of so much, like $20 on this particular date, then a lot of people would go for the minimum payment, but they're not realizing that when they do that, then you're ending up paying more interest. So what you want to do, which is what I'm always doing, I would pay way more than that £20 or that $20 that they are saying I can pay. So I would pay like $40, and I would make sure that I pay it like way before the due date, like 5 days or say 10 days before the due date, to make that payment. So when the credit card company realizes that you are doing that, they now think that this guy is really managing his or her account very well. So at some point they will even offer you a higher credit amount. Like for me, sometimes they would send and say, okay, we realize that you are managing your account, so we can offer you a higher credit. Sometimes I accept and sometimes I refuse, because guys, the more you're exposed to credit, especially if you're not good at money management, then it's more tempting it is for you to take so much credit And then when you're spending other people's money, guys, you need to remember that you have to repay it. So that's very important. So that's just some tips for you to maintain good credit. And it says they'll also find the best terms, including higher dollar limits, which can make it easier to finance big purchases. So when you have a good credit score, guys, you have the power. You can go and you can get credit whenever you want at favorable interest rates. The other thing is you can have access to the best credit cards. So you have credit cards with 0% interest, like for 6 months or even for a year. So you have stuff like that where you can save, a lot of money. So that's the power of having good credit score. And it says high credit scores will afford you access to the most rewarding credit cards on the market, including those that offer the lowest interest rates and the best rewards, such as cashback offers, travel points, and other incentives. You are also more likely to qualify for an introductory 0% APR purchase and balance transfer offer. And a number of times they would send me email that, you can get this credit card if you pay off or transfer all of your balances to this credit card. You won't pay any interest for 6 months, stuff like that. So that's the power of having good credit score. And you also get insurance discounts. Could be your car insurance. You would get discounts on your car insurance because you have good credit, and you have more housing options. So for those people, even if you're renting a house from some landlords, some of them will do credit checks on you to make sure that you're financially trustworthy. You are able to repay, or you're able to pay your rent each month. So the higher this credit score, or the higher your credit score, the more likely you are to be approved for home or apartment rental. And you could also save money on your deposit, and also security deposit waiver on utilities. So some utility companies may consider your credit report and scores to determine how likely you are to pay your bills on time. If you don't have a strong credit history, you may have to pay a security deposit to initiate utility services. So it's important to have a good credit score, guys. And then you might ask, so what is a good credit score? So, it really depends on, the organization and all of that. But while there are countless credit scoring models on the market, one of the most commonly used is what they call the FICO score model, which places scores in a range between 300 to 850. So like for Experian, which I'm always using, their credit score is 999. So if you are scoring like 700 and over, you would consider, I'm going to show you my credit score, you would consider that to be, a good credit score. Then you have very good credit score, then you have poor credit score. So it all depends on the credit score organization. They will actually tell you, their score, what is good from, what is not so good. But like some of them would say 800 and above is exceptional. Very good would be 740 to 799, and then you would have good would be 670 to 739, and then poor credit score would be like 579 and below. So generally a score of 700 or above would be considered a very good, not very good, but a good credit score if you're using like the FICO organization. So it says, how can I improve my credit score? So like for me, as I told you guys, like what I've done, because I remember at one point I had bad credit. I remember I even had to go into what did they call it? I think it was like money management, because what I actually did was, my credit score was good some years ago, and then I was helping out a so-called friend to co-sign for a motor car that he needed. At that time I didn't understand much about having good credit score. I didn't know that I need one, because I just moved to the UK, and even though I could get loans, I still didn't even realize that I was building a good credit score. And then I went and I co-signed for him, not knowing that he had a bad credit score. So he could not get a car loan on his own. So I went and he made the first payment, and then the second payment he didn't, so I had to pay it. And then luckily the only smart thing I did at that time was that I had the car registered in my name. If I had it registered in his name, then I would have a hard time getting the car back from him, because even though it was in my name, it took weeks for me to get it back from him. I had to go to the police, and I had to, at one point I had to go back to the car place where we bought the car, and I had to tell the guy, can you just tell him that something is wrong with the car, for him just to take the car back, and we would be here waiting. When he comes with the car, we would just take it. And that's how we managed to get the car back from this guy. And that affected my credit because I couldn't make the payments, and then I ended up having bad credit. I could not even get what they call I had to use like this cash card account. I couldn't get a current account from the bank, so I had to settle for a cash card account. So when you have bad credit, it can really damage everything that you would want to do. So you have to make sure. And if you're somebody who watch Judge Judy, you would always see cases where people would come and say, their credit score has been affected because somebody borrowed money and they didn't pay it. Guys, that is something you have to be careful of. When you have to co-sign for somebody and they mess your credit up, you don't want that to happen. It's best if you give them the money, if you can give them, or you just tell them no. Let them go and get upset with you, but you'll be maintaining a good credit score, because once your credit is messed up, it's going to take years for you to build it back. And it took me years to build mine back because I could not get any loan for a number of years. I could not get any kind of credit because at one point I was also on IVA. I think it's individual voluntary agreement or arrangement, where all your creditors would agree that you can pay a certain amount. So you pay just one figure for all the creditors that you owe, and then at some you paid that money for a number of years, certain number of years. I think mine took 7 years, and then they would write off the rest. So that's what I had to do, and then I started building my credit back from there until I'm speaking to you right now. I have an excellent credit score. So that's what you have to do, guys. And when you're talking about these small groups telling you to take out loans, like the dream team, I'm always talking to you about the dream team telling you to take out loans to buy into their multi-level marketing business opportunity. Guys, you have to be very careful, because you can mess your credit score up by doing that if you can't make the monthly payments. So this is why you have to be very careful. And so these are some of the ways you can improve your credit score, by paying your bills on time. Don't pay the minimum payment that the credit card company would require you to pay. Pay higher than that. And if you can pay it all off, it's best if you would do that. And if they give you a date to make that payment, make those payments way earlier than the date they would give to you. So they would see that you are managing your debt in a timely fashion. You're not late with your payments, especially if you don't have like direct debit set up, because I don't have any kind of direct debit set up on any of my cards. So I have to make sure I remember to make the payment. So what I would do is just pay early. As soon as I get a message or an email from the credit card company to say your bill is due at such time, I just quickly go and pay it, and I would pay way more than what they requested. So there is no secret sauce to getting good credit scores. Generally speaking, the best way to improve your credit score is to do the opposite of what caused them to go down in the first place, and give yourself enough time for them to improve. While each scoring model gives different weight to the factors that affect your score, there are usually 7 factors that go into determining, your scores. And you have payment history, you have credit utilization ratio, you have number of accounts. So the number of accounts you have, your credit score model also look at how many credit card accounts you have open and on how many you carry balances. So it's very good, guys, to keep the balances on your credit cards low, and especially if you are going for a mortgage, you should never go and take out any new credit, because that will really affect your mortgage application. Because remember, the mortgage lenders want to make sure that you can afford those mortgage payments. And remember, when you're talking about mortgages, that's the biggest outgoing that you're going to have in terms of credit. Some people over £1,000 per month you have to make each month, and you have to make sure that you make those payments on time, because then you can lose your property. And they also look at your credit history. So most scoring models also look at how long you have actively used credit. They typically look at the average age of all your opening accounts or all your home accounts. The longer your credit history, the better it is for your score. And you can't do much about this one other than let time do its thing. So they also look at how long you have those accounts open, and how well you're managing. And also, you also need to be on the voters register. Like in the UK, if you're not on the voters register, then that can also prevent you from getting certain credit. Like you're talking about mortgages, they will check your credit score or your credit report to see if you are on the voters list. And your address, guys, your address can also have an impact on your credit score and whether or not lenders will lend you money. So if you are somebody who keep moving from one address to the next in a short space of time, like 2 years, 1 year, 3 years, you keep moving. Like for me, where I'm living at this apartment from 2004. Now we are in 2022, so I've been living here for very long. So credit companies always like to see you at the same address for a long period. So you have a lot of stuff that goes into it. You have credit mix, that scoring models also take into account what type of credit you have, including installment loan and credit card. And hard inquiries, or what they call hard search. So when you apply for like a new credit card or another kind of loan, like unsecured loan, the lender will request your credit report. So they are doing a hard search. That can also affect your credit score, especially if you are refused credit, or if you allow these hard searches to take place in short space of time. That can also affect your credit. So you have to really do some research to see how you can maintain a good credit. That is considered hard inquiry, and too many can lower. If you do too many hard searches, that can lower your credit slightly. You have light searches, and then the light searches don't really affect your credit score, but when you have to do hard searches, like when you go in for a loan, that can affect it. And multiple inquiries of the same kind. So if you're making multiple inquiries, like for a loan, in a short period of time, like a car loan, for example, that can really affect your credit somehow. So you have to be careful. And then negative credit information, like sometimes I go like I had a loan from a bank and a complete payment of that loan, but then it was not updated on my credit file, so my credit report was showing something different, so it lowered my credit score, but now I have that fixed. So because sometimes it takes a while when you completely pay, because what I did was to make early payment on my loan just to clear it. So I had 2 years left on that loan, so I just cleared the balance. So the credit report was still showing that I have that amount of money outstanding. So that can also affect your credit report. So you have to make sure you check your credit report, not just going on one credit agency and check your report, because you might have another one showing that you still have loan outstanding when you don't have any loan outstanding. So that can give you negative credit information. So that's really what you have to do, guys, to really protect your credit report. And what is a credit report? So we are coming down to the end of this video just to tell you a credit report is a record of your history managing and repaying debt. And sometimes this is from like 3 different or 4 different companies. I told you about Experian, and you have Equifax, and then you have another one. So I told you about all of them, and all 3 of them combined in one report. So it shows you what your credit score is for all 3 of them. And it works as a kind of report card lenders and other companies view when deciding to do business with you. Included in your credit report is a historical record of how and when you pay your bills, how much debt you have, and how long you have been managing credit accounts. So as I said, guys, once you make your payments on time, once you make more than the minimum payments that the credit card companies would require, then you're in good standing to have a good credit report, and obviously our good credit rating. Obviously, like if you borrow a loan, then you'd have a specified amount each month. But when it comes to credit card, the credit card company would give you a minimum amount to repay each month, so you have to know that you need to pay more. And even the credit card company would offer you options if you want to make this amount of payment or if you want to pay the exact amount. Now you have to decide and make sure you pay on time. So a lot of people, if they don't want to miss payments, they would set up direct debit so that the payment can come out. You don't have to worry about that, the payment is going to come out. But then you have to make sure that you have money in your account so that that payment can go out seamlessly. So what is in a credit report and how do you read it? So a credit report is a readable presentation of the data stored in your electronic credit file at one of the 3 national credit bureaus like Experian, TransUnion, and Equifax. The information stored in your credit file at each bureau is essentially the same, but each bureau organizes the data differently, and each format its credit report in its own way, guys. So your Experian credit report, like what I have, is divided into 4 sections. So you have like the personal information, you have the account section, you have inquiries, you have public record, then you have how is a credit report made. And so you have a lot of stuff that you have to do your own research to know how a credit report is made and why is your credit report important. So I explained to you why it's important. You can get good interest on your your loan, your mortgage, and you would want to ask, so when do I get a credit report? So if you are going to take out like a mortgage, or even a car loan, it would be a good idea to check your credit report before you even make your application, so that you know fully well if your credit is good, what is on your report, if everything on your report is okay, so that when these mortgage companies go and do their checks, then you know definitely that you're in a better position for them to approve your mortgage, approve your car loan, or approve your unsecured loan. So guys, that's what I want to talk to you about with credit report and credit files and all of that. So based on the response I get, then I will do more videos on this, because I think it's important, and a lot of people, especially young people, might not see your credit file or your credit score as important, but it's very important. This can really help you, because we always don't have cash to buy everything we need. We don't always have cash to buy a brand new car, so we need to have a good credit score in order for us to get a loan to buy our car. And once we can make those payments, then we'll always be at an advantage to to get a loan, to get a mortgage, and not to take out a loan to do foolishness, but to make sure that when you're going to take out a loan, especially if you're going to invest in a business, is something that you're going to make your money back, because they need to make those monthly payments. So again, guys, thanks for watching this video. And before I end it, you can see like my credit score here. You can see that my credit score is excellent. You can see that I'm scoring 966 out of 999, so that's excellent. And as you can see, I'm in a good position to tell you how to maintain your credit, and you can do the same. You can get to this position, so I'm in a better position to get loans whenever I apply for loan, or if I need a brand new car now, I can apply for a car loan and I'm sure I would get it. So again guys, if you like this video, give it a thumbs up, leave a comment to let me know what you think, and also to subscribe to this channel if you have not done so yet. So thanks again for watching, and catch you in another video.